Hello and welcome to this in-depth look at one of the most shocking events in the recent history of cryptocurrency, the rise and collapse of FTX, led by Sam Bankman-Fried. If you've been following crypto markets, you know that exchanges are crucial. They're the gateways for newcomers to convert fiat money into digital assets. They're also where seasoned traders operate, juggling coins, tokens, and futures. By 2021, these platforms were raking in massive revenue and fueling global speculation. Yet no one predicted that a prominent exchange like FTX could implode so suddenly, leaving billions of dollars in limbo. Before we dive into FTX specifically, it's worth recalling the crypto euphoria from 2020 to early 2022. Bitcoin soared, and decentralized finance, DeFi, boomed. NFTs were all the rage. This environment of robust market activity and capital inflow helped FTX catapult itself into the big leagues, surpassing rival exchanges in certain sectors. At one point, it almost seemed like FTX was unstoppable, until it wasn't. Sam Bankman-Fried, often referred to by his initials, SBF, studied physics at MIT and later worked at Jane Street Capital, a prestigious trading firm. In 2017, he established Alameda Research, a proprietary trading company focusing on cryptocurrency. Using quantitative strategies and arbitrage opportunities, Alameda generated large profits by exploiting price discrepancies in different regions. SBF quickly became known for his intellect and strategic thinking. He also displayed a philanthropic slant, publicly committing to the idea of effective altruism, the belief in earning as much as possible so you can donate effectively to important causes. Initially, many in the crypto space admired him not only for his quick success but also for promoting a philanthropic ethos. Not content with just trading, SBF co-founded FTX in 2019 along with Gary Wang and other partners. The goal was to build a crypto exchange by traders for traders. Early on, FTX differentiated itself through advanced features such as high-leverage derivatives, unique indexes, and a user-friendly interface. SBF's approach was partly shaped by the experiences he'd had at other major crypto exchanges. He wanted faster order execution, more intuitive design, and deeper liquidity for derivatives. This focus on advanced trading tools appealed to hedge funds and retail speculators hungry for bigger bets. While many crypto executives opt for quieter profiles, SBF became a public figure. He appeared in podcasts, on Twitter, and at major conferences, sometimes wearing his trademark t-shirt and shorts. His unpolished style contrasted with the professional veneer of typical Wall Street executives, and this underdog persona enhanced his appeal to the crypto community. Alongside his approachable image, SBF promoted FTX aggressively through sports sponsorships, naming stadiums, and signing deals with celebrities. Over time, FTX branding appeared on Major League Baseball umpire uniforms and on the home of the NBA's Miami Heat, FTX Arena. This rapid marketing expansion hinted at the exchange's growing ambition. FTX quickly became known for its specialized products, such as leveraged tokens, synthetic assets letting users hold leveraged positions without actively managing margin, move contracts, betting on the magnitude of Bitcoin's price movement within specific time frame, tokenized stocks, tradable representations of real-world shares. These unique offerings drew sophisticated traders. Liquidity deepened, daily volume soared, and FTX's market share steadily climbed. The platform's listing of smaller cap tokens and fresh DeFi projects also drew interest from yield farmers and meme coin enthusiasts. To solidify its position, FTX pursued acquisitions and formed partnerships. SBF relocated to the Bahamas, a jurisdiction with more accommodating crypto regulation, allowing FTX a global footprint with fewer compliance headaches than in the US. Venture capital began pouring in. High-profile funds like Sequoia Capital and SoftBank joined funding rounds, pushing FTX's valuation to tens of billions of dollars by mid-2022. New capital fueled expansions into multiple regions, from Europe to Asia, as well as marketing deals that kept the brand visible even to non-crypto audiences. Throughout this meteoric rise, SBF consistently referenced his philanthropic aspiration. He pledged significant portions of his wealth to various causes, primarily related to pandemic preparedness and global poverty reduction. Meanwhile, FTX Foundation and related philanthropic arms were launched, further enhancing the perception that SBF represented a responsible, purpose-driven face for crypto, an industry often portrayed as rife with speculation and scams. Despite the hype, a number of industry observers quietly voiced concerns about the relationship between FTX and Alameda Research. In theory, an exchange should remain neutral, ensuring fair markets for all participants. But rumors circulated that Alameda had special privileges, like faster liquidation data or preferential fees. At first, such suspicions were brushed aside. SBF insisted that Alameda operated independently, with Chinese walls preventing insider knowledge. However, in any environment lacking robust transparency, these reassurances failed to entirely quell skepticism. As crypto markets became more volatile, critics questioned whether FTX and Alameda were over-leveraging. For instance, if Alameda held large proprietary positions on FTX, a severe downturn could cause margin calls that might strain the exchange. Some observers noted parallels to previous collapses in crypto. When a large entity also owned a trading arm, it opened dangerous conflict of interest possibilities. Additionally, FTX launched its own native token, FTT. Early employees and affiliated projects held large amounts of FTT, which functioned like a loyalty or utility token. If the price of FTT were to crash, it could jeopardize the exchange's reserves or credit lines, particularly if FTT was used as collateral in certain lending or margin deals. By early 2022, broader macroeconomic uncertainty, rising interest rates, and the implosion of major crypto ventures like Terra/Luna and 3AC had triggered a market downturn. Trading volumes dropped, venture capital money slowed, and cryptocurrencies lost much of their froth. In such a scenario, heavily leveraged entities risked major losses. Despite the tough condition, FTX reassured users that its finances remained healthy. SBF stepped in as a white knight for some failing project, like lending money to crypto brokerages in distress, presumably to protect the ecosystem and expand FTX's influence. The final catalyst arrived in November 2022, when Binance CEO, Changpeng Zhao, CZ, announced plans to sell off a large quantity of FTT tokens, FTX's native token. CZ cited risk management and rumored concerns about FTX's solvency. This triggered fear across the market. If Binance worried about FTT, did it mean FTX was overextended? Panic ensued. FTT's price plunged, and users rushed to withdraw funds from FTX. The exchange, once lauded for its speed, couldn't meet all redemptions promptly. Critics suspected FTX might be using customer deposits to prop up Alameda's losses or to artificially sustain the FTT price. Amid the panic, SBF initially claimed FTX assets were fine, only to reverse course days later, acknowledging a liquidity crunch. In a stunning series of events, FTX halted withdrawals. Binance floated a takeover rescue but quickly walked away upon examining FTX's finances. Documents revealed a multi-billion-dollar shortfall and alleged misuse of funds. By mid-November, FTX, Alameda, and numerous affiliates filed for Chapter 11 bankruptcy in a U.S. SBF stepped down as CEO, replaced by restructuring expert. This collapse echoed earlier fiascos in crypto, like Mt. Gox in 2014, but on a scale that overshadowed them, wiping out tens of billions in net worth almost overnight. Authorities in multiple jurisdictions launched investigations into FTX's downfall. In December 2022, Bahamian police arrested SBF at the request of U.S. prosecutors. A flurry of charges followed: wire fraud, securities fraud, conspiracy to commit money laundering, and campaign finance violation. U.S. regulators alleged SBF used customer funds to cover Alameda's losses, undermining the core principle that exchange assets must remain segregated and secure. As legal pressure mounted, top lieutenants at Alameda and FTX turned cooperating witnesses, claiming SBF had orchestrated or condoned using FTX deposits to backstop Alameda's leveraged trade. These revelations cast serious doubt on the notion that lapses were accidental or that SBF was unaware of the financial intermingling. Politicians worldwide seized on FTX's failure as evidence that cryptocurrencies required stricter oversight. Hearings in the U.S. Congress explored whether the Commodity Futures Trading Commission, CFTC, or Securities and Exchange Commission, SEC, should assume more direct control over crypto exchanges. Meanwhile, the European Union accelerated work on its markets in crypto assets, MiCA, framework. The notion that crypto is the Wild West gained traction, with FTX's example fueling skepticism among regulators and the public. The FTX meltdown not only destroyed SBF's personal fortune and reputation, but also left thousands of users with frozen funds. The downfall eroded trust in centralized crypto platforms, reinforcing the adage, "not your keys, not your coins," meaning that self-custody might be safer. The fiasco echoed themes from previous crypto bankruptcy: lack of transparency, risky leverage, and reliance on self-issued tokens as collateral. Until the crisis, many assumed FTX's size and popularity rendered it too big to fail. Indeed, SBF's philanthropic posture, celebrity endorsements, and entrenchment in political circles seemed to afford the company a certain safety net. However, the abrupt collapse demonstrated that crypto exchanges, no matter how prominent, are not immune to classic failures of liquidity and solvency if risk management is neglected. The FTX saga has accelerated debates on how to implement proof of reserves, requiring exchanges to prove on-chain assets match user deposit. Centralized exchanges began touting more robust disclosures. A shift toward decentralized exchanges, DEXs, also gained momentum, as these platforms allow direct trading without trusting a custodian. Regardless, the episode reaffirmed that thorough due diligence, external audits, and basic financial discipline matter as much in crypto as in traditional finance. SBF's public persona of altruism has now been overshadowed by allegations of gross financial impropriety. The gap between branding, philanthropy, humility, and behind-the-scenes actions, allegedly repurposing user funds, highlights how a charismatic leader can lull stakeholders into complacency. This underscores the caution that the cult of personality approach, common in Silicon Valley and crypto, might mask deeper issues. The boom and collapse of FTX and the subsequent downfall of Sam Bankman-Fried serve as a stark reminder of the crypto sector's volatility and vulnerability to mismanagement. What seemed like unstoppable success, backed by advanced trading tools, brand partnerships, and philanthropic ideals, unraveled within days once trust eroded. The meltdown tested regulators, triggered lawsuits, and reshaped investor sentiment about centralized crypto platforms. Looking forward, the FTX cautionary tale signals an inflection point. If crypto's future is to be stable, robust governance and transparent auditing must become the norm. Exchanges must respect boundaries between their own proprietary trading arms and user deposit. Meanwhile, investors, retail and institutional alike, must apply a critical lens to next-generation startups promising quick expansion or philanthropic flourishes. The saga of FTX and SBF underscores that, in finance, fundamentals still reign supreme. Capital must align with real liquidity, tokens must be backed by tangible assets, and leadership must be held accountable by checks and balances. As the legal proceedings against SBF continue and the crypto industry recalibrates, one enduring lesson emerges. Even in a novel digital landscape, the timeless principles of responsible stewardship, verifiable reserves, and prudent risk management remain as vital as ever.